Hello and welcome to Investor's Edge. In this video, we are going to explore the fundamentals of options and how they can potentially be used to capitalize on price fluctuations in the marketplace and add returns to your portfolio. So what are they? Let's start off with an example from the real estate world. Suppose your house is worth $750,000 on the market today. A friend of yours, who is rather optimistic about the housing market, comes to you and says that she would like to strike a deal with you. For 12 months, she will have the right to buy your house for $800,000 at any point throughout that 12-month period. She wants to make this deal with you because she thinks that the price of your house will skyrocket above $800,000 in the coming months. If you say yes to her proposal, what's in it for you? If the value of your house does not go above $800,000, your friend will not exercise her right to buy it from you at that price if she could get it for a lower amount on the market. Now let's say your house does skyrocket to $900,000. Then your friend will gladly exercise her option and you are obligated to sell your house to her for the agreed upon $800,000. In this example, you will be missing out on $100,000 of price appreciation. Are you going to hand those rights over to your friend for free and potentially miss out on those gains? The answer is no. Your friend must pay for those rights. If we use option terminology, the payment for those rights is called a premium. You are the option seller and you will collect this premium up front. This agreement is called a contract and it expires in 12 months. I have just introduced you to an example of a call option. So now we take that concept and apply it to stocks. An option is a contract to buy or sell a stock in the future at a designated price, otherwise known as a strike price, for a specified period of time or up until the expiry date. To start, there are two types of options. There are call options and there are put options. A call option gives the buyer the right to purchase a stock at a strike price up until the contract expires. If the owner of the call exercises her right, the investor who sold that option is obligated to deliver shares in exchange for cash. A put option, on the other hand, gives the buyer the right to sell a stock at the strike price up until expiry. If a put option buyer exercises her right, then the option seller is obligated to buy the shares from her at that same strike price. Notice a trend here? Buyers of options have rights, whereas sellers have obligations. When we buy a stock, we are buying individual shares of a company. When we buy options, we are buying contracts. Most contracts represent 100 shares of the underlying company. Therefore, since the option price is quoted on a per share basis, we must multiply it by 100 to get the overall dollar figure. Now, most equity and ETF options are referred to as American style, meaning the buyer of those options can exercise her rights at any point throughout the term of the contract prior to or at the expiration date. Option prices continue to fluctuate up until expiry. So which factors impact these prices? Without getting too granular, the main factors that will influence the price of an option are the underlying stock price, the option's strike price, the time until expiration, interest rates, dividend payments, and volatility. If we examine the relationship between time to expiry and the cost of the option premium, we will notice a couple things. The greater amount of time to expiration, the more uncertainty there is on where the stock price will end up, which translates into higher premiums. Longer dated options therefore have greater time value embedded into them and are more expensive than those with earlier expirations. The option itself is made up of two components, intrinsic value and time value. The intrinsic value for a call option is calculated by subtracting the strike price from the current stock price. For puts, you would subtract the stock price from the strike price. Intrinsic values can only be positive, so if you do your math and it comes out negative, then the intrinsic value is just zero. Time value is calculated by subtracting the intrinsic value from the option premium, and it erodes to zero as the contract expires. Here is an example of the components of a call option premium. XYZ stock is trading at $25 and the $22 strike call option can be purchased for $5. Doing some quick math, we know the intrinsic value is $3, so the time value must be $2 to add up to the $5 option premium. For our put option example, we get the intrinsic value of $2 by subtracting the stock price of $20 from the strike of $22. This means the remaining time value on the contract is $2.50, which adds up to our option premium of $4.50. Now we're going to take a look at a call option chain. XYZ stock is currently trading at $11 with the option prices listed. Any contract that has intrinsic value can also be referred to as in the money. Here, only the $10 call option is in the money. If the stock price is the same as the strike price, then we refer to it as at the money. And finally, if the strike price is above where the stock is currently trading, it is referred to as out of the money. The only options that will have any value at expiration are the ones that are in the money, because again, time value will be 0. Now that we've gotten the terminology out of the way, let's piece everything together. Why would you buy a call option in the first place? Remember, call options give us the right to buy a stock in the future at a predetermined strike price. If we are going to do this, then we must have a positive or bullish outlook for the company. The risk associated with our trade is confined to the premium we pay to enter the contract. If the contract expires worthless, then the amount we lose is simply the amount we put in. Looking back at an earlier example, we now illustrate the call option payoff for buying 10 contracts of the XYZ $12 call option for 95 cents per contract. The option is not in the money until the underlying stock hits $12. The break even on the trade can be found by adding the option strike of $12 to the 95 cent premium that we paid. Therefore, the stock price must be above $12.95 at expiry for us to make a profit. Let's say the stock closes at $16.50 on expiry. Our profit is calculated by subtracting our break-even price of $12.95 from the current stock price of $16.50 and multiplying it by our share exposure of 1,000. This gives us a profit of $3,550 on an investment of only $950. If by comparison we purchase 1,000 shares of XYZ at $11, the same stock price of $16.50 would generate a return of $5,500 or 50% over that same period of time. So now that we've talked about calls, let's illustrate a put option which you would purchase if you have a bearish view on our particular company or you would like to buy insurance on some of your existing portfolio holdings. Here we have XYZ trading at $18. We buy 10 contracts of the $15 put for $2 per contract. If the stock closes at $8 on expiry, it would be $7 in the money, so our profit would be $5 per contract, or $5,000. Now what would happen if the stock closed at $16.50 on expiry? The $15 put would be out of the money and therefore worthless. You would lose the $2,000 premium you initially paid. There you have it. You now have a basic understanding of what options are and how they work. Stay tuned for more videos as we dive into how you can view and trade options on our platform, along with other option strategies. Thank you for watching.